All righty. Hello, everyone. Welcome to AdvisorFirst Monday Kickoff meeting, January 24th. Our main event today is 7 core investment principles plus 7 facts about the market. I think today's session with a couple little other training snippets is a very good one for securities overview, how to explain securities, etc. First thing off the bat, I want to say happy birthday to Julian. 27, as we talked about earlier. He confirmed that is in fact his age. Forever. And so anyway, congratulations. Thanks for being on your birthday. That's fantastic.
Thank you.
Wonderful. All right. Let's, in fact, speaking of Julian, let me go back. Let's do the leaders board. So we're going to go here, and we're going to go here. And we're going to click this button and that button and this button. There we go. So shout out to, so we have our paid revenue and our submitted revenue. I'll go with submitted revenue first. Is shout out to James Lamb, just submitted a life case yesterday. I think he's got another one coming too, $600, $50 a month. Congratulations. He said it was a pretty easy process. I think he used the same one I do at the time, which was Lincoln, using iPipeline, the e-submission app, whatever. So shout out there. Paid revenue, Reginald. Also, these were life cases. These are, so remember, this is paid. This is what actually got paid on the computer. Commissions paid the whole deal, $4,400. And that was on top of like $3,000 the week before. So shout out to him. Julian with $3,200 paid out. And birthday boy doing it big. And there's James Lamb, myself, and Omar. So that's the leaders board. You can always get here from leaders.advisorfirst.org. Okay, let's jump over to our quiz. The quiz from last week is what is the record date or record date of a mutual fund dividend? And not that comes up that often, but it is important to know. And Isla, you want to take a stab at it?
Okay. The date of the
And just for everyone watching this, Isla almost every week tries to jump in and do the quiz, which I appreciate because she doesn't, see it on the Telegram during the week. Like this is the first time she's seeing it whenever she sees it on Mondays.
date of border. I don't know this.
That's okay. If you don't know, I'll just tell you.
Okay.
It's the second one.
Uh-huh.
It's the day one must own the fund to receive the dividend. So that's the reason we put this quiz in here years ago. It's not that you can go 3 years and never even say the word record date or record date. You know what I mean? But what is important to note is that a client has to own the fund on this particular day to get the dividend. So if the dividend's paid, December 15th, the client has to own it, December 14th to get the dividend.
I see.
Okay. So, which kind of makes sense, but you might think, well, maybe they have to have money in it, or well, of course you have to have money in it, but maybe they, it's some other date. But it's just very simply the record date is the date that the client must own the fund to get the dividends being paid out in this quarter or whatever, whenever the dividend's being paid out. Okay. Yep, that's it. That one's pretty straightforward. Okay, let me go back to Jetsai and toggle. Yeah. All right, so let's go through a few our little weekly. Okay, pro tip, listen to the Capital Group / AdvisorFirst American Funds podcasts. There's a lot of great content out there and we post everything, but I just want to throw that out there as the podcasts are pretty good. Most of the time, they're not super technical. They're also publicly available, which means that the public can listen to them. And of course, I always post them not only post all of them, but the ones that are relatively good, in my opinion, is I post them in our dailies and in the Telegram chat group and also send them with the newsletter. So I think it's a good way to keep in touch with the market. They're not going to help you sell funds or market things. There's not really any sales tips, but it gives you a general idea of the market. What I do like is they bring a lot of non-investment people on board on the podcast. It's not super technical with some rare exceptions. It's more about general markets, sometimes very fascinating stuff.
They should apply it to bonsai.
They should. I'm sure there's a bonsai podcast.
Then I'll watch it.
Then you'll watch it. Right. Okay. Prospecting / activity tip of the week is make 1 to 4 prospecting attempts every day, 5 days a week. Okay. It's not easy, but it is simple. And the sales scripts technique of the week, which kind of ties a little bit into our main topic today, which is the 5 stages of explaining mutual funds. It's just little 5 steps in your head. You might explain it differently than we teach, whatever. But I think if you keep these 5 like bullet points, this will help you, because you want to have a mental outline of what you're trying to explain to a person. So you want to explain from the basics what a mutual fund is. Absolutely, the pencils.
And the baggies.
And we'll get into that. It's absolutely right. Number 1 is have them understand compound interest. Number 2 is the Ibbotson color chart. And all that means, a simple way to do the Ibbotson chart is, large and small companies have averaged 10 to 12% since 1926. Inflation's like right around 3. Bonds is like 3 to 5. That whole chart, right? Or just say that verbally, but we'll just call it the Ibbotson chart. That's number 2. Number 3 is the mutual fund with the pencils, right?
Like and the baggies.
Boy, we're getting to that. So and you can even do it verbally, right? A stock is 1 pencil. You can break it easily. A mutual fund is 150 pencils rather than rubber bands. Pretty hard to break. Okay. So you can even do the pencils verbally. Number 4 then is the ICA. Knowing those ICA statistics, even if you don't necessarily are going to market the ICA to the client, and you even tell them, this may not be the right fund for you. We may choose something different, but this is a great example of a fund. And then number 5, as Isla's mentioned, is the tax shelters, and that's where you do the baggies, right? And again, even if you don't physically have it with you, if you just mention the pencils and you say, look, we're going to take these pencils, and imagine a clear Ziploc bag. You take the pencils, put them in a Ziploc bag, zip it up. Well, that Ziploc bag is the taxes. The government can see your mutual fund. They can see the pencils, but they can't touch this, like MC Hammer taught us. Okay.
Don't do the MC Hammer, depending on the age of the age of your clients.
Yeah, no, definitely.
They're
do
like,
it.
who?
The younger crowd loves it. So, but the last thing on that is these 5 steps is what you're doing is going from general to specific, right? You're going from general idea of compound interest is an important thing to understand and how valuable it is. And then you're going more specifically, what are some general places one could invest and what's better? And of course, is large and small companies across the whole world. And then you're giving talking about mutual fund is the best method of investing. And then you get even more specific with the IC and give some hard facts, right? And then you just talk about the baggies. Now, each of these is a whole longer training, but just remember those 5 steps. And then no matter where you're stuck, at a cocktail party or a dinner with someone, kind of keep those in mind, and boom, you got it.
But I think you should also probably be aware of how long you're going on, because if you're not getting a lot of, like, the client's just quiet, I'd shorten all that real fast.
Yeah, of course. Absolutely. Yeah, you might jump right straight to the ICA or mutual funds, or someone understands compound interest. But just for you from going from scratch, because you might be surprised how many people don't know compound interest, even like now in 2022. I've had conversations with people and they don't understand, they think 12% is double 6, for an example, and it's not. So just because you might know and you might be doing this for decades, don't assume everyone else does too. Okay, updates. I mentioned it before. I want to mention again, the AdvisorFirst self-study curriculum is pretty much done. So if you haven't completed that yet, it's a great place to start. It's on the knowledge bit on the wiki, and it's a great kind of give you an idea of what should I be doing next in terms of training and learning. The work is always the most important thing. 80% of what you should be doing is working the business, but there is that 20%. We're always trying to get better. The curriculum helps you do that. And that was it for announcements. Since Julian's on with us, Julian, do you have anything to say in terms of announcements, updates, or anything that we've talked about?
Nothing so far on this end, but still working on a few small projects. But once those get completed, I'll make those announcements later.
That sounds great. Okay, and definitely feel free to jump in at any point in time on this presentation. So we're going to jump right into the presentation. Let me go back and do a screen share. Here we go, and we're back to here, and we're back to here, and there. Okay, Julian, you can see that, I assume?
Yes, sir. I can see that.
Thank you. I appreciate that. Okay, so we're going to talk about today, and these are all a little bit more concepts, but I think this is one of the most important things to learn in our business as an advisor, because a newer advisor, but it's good recap for existing advisors. And it's kind of what I just said a minute ago. It's sometimes we learn this stuff and then we forget that other people don't know it. Okay, so this is on the wiki. It's under investment principles right here where my mouse is, my little drawing program isn't working today. So I'm using the mouse by itself, but it's under investment principles, and it's actually investment principle number 2. So it's pretty early in the investment principles list. It's called the 7 core investment principles. Okay. And I'm not going to read everything in here, all the quotes and all that stuff. You guys can do that, but here's what the 7 ones are. And this goes a little bit together with what we did a minute ago with the scripts, which is pure coincidence because the scripting stuff I do every week, right? The script of the week or whatever is on like a rotation, and it just happened to coincide with today. But this is another one of those things where it's like, I think the 7 most important, this is like an expanded, longer version of what we just talked about, the 7 most important investment principles, in my opinion. And this is all stolen from other people over decades. But I narrowed it down as far as I could, but I think you shouldn't go less than these 7. You could do an entire presentation about it. The first one is, we've talked about this before, is invest in the world's great companies. If someone said at the end of the day, why do you always talk about equities, and why, even in retirement, we talked about that last week, why are you doing equities, not bonds? This is kind of the main fundamental, which is invest in the world's great companies, right? And all the reasons for that, okay? Now, here's what I'm going to do. The second part of today's training, if you saw the title, was the 7 investment principles, plus it was 7 facts about the market, which is really awesome. And this one you kind of do want to memorize, but I'm actually going to skip it and do it at the end. But it's part of number 1. So we're going to jump to number 2. Actually, you know what? Maybe I won't, because the next one's build on. Okay, so invest in the world's great companies, right? And why? Because of the Ibbotson chart. We talked about that before. So why invest in the world's great companies? Because since 1926, I guess it is, large and small companies have averaged between 10 and 12% and blows everything else away long term. Okay. Why? Now here's 7 facts. So we're all going to do this one now because it's part of number 1. I love this because the way I've always kind of explained it is with this sentence right here, or I guess there's 2 sentences. The market does what it does. If you know what's going to happen, it's not risky. If you know what's going to happen, it's not stressful. If you know how it works, then you're not going to be surprised, right? The market does what it does, and it always does what it does. You don't always know how long all these things happen and to what degree they happen, but they do happen, and they do happen in cycles. It's not a perfect science, but when you look back on history, this is what happens. So number 1, actually, we just talked about it. Number 1 is since 1926, small U.S. companies, it doesn't talk about the large ones, but small U.S. companies have averaged 12%, which inflation has been 3 and bonds have been 6. It is what it is, right? That's why you probably should, I tell clients and tell advisors, you shouldn't be, as a general rule, long-term, be talking about much more than 12%, other than if you have a specific investment or fund that has done that, like the Growth Fund of America has done over 12%. New Perspective Fund has done over 12% for decades, but as a general rule. Number 2, declines of -5 occur about 3 times a year. Declines of -15 occur once a year. Declines of 30%, this is called the bear market, occur about once every 5 years. Since 1926, so the same time frame, 40 months is the average length of time it has taken for a bear market to break even. So when you have a number 4 and you have a -30, okay, and that doesn't mean it does -30 in one day or in a week. It's like a sustained. And all this there's not a perfect science. It's well, if it's 11 weeks, then it's a bear market. If it's only 10 weeks, it's not. It doesn't work like that. But these are general things. But once you have these bear markets that occur about once every 5 years, then it takes about 40 months on average for it to come back to break even. Number 6, markets rise about 3 out of 4 years, 75%. So 75% of the time, or at least on an annual scale, the markets go up. 25% of the time they go down. That's what they do. So when it goes down, when it's a 25%er, not 25% down, but if it's in a quarter of the time frame, it does go down. Why are you surprised? Okay. And finally, number 7, volatility is not risk. V does not equal R. Volatility, by the way, technically speaking, is going up and down, right? So when a market goes up really quick, that's actually considered volatility too. But most people that even have like a little bit of a semblance of knowledge about investing, they think, and they've heard volatility, they kind of get it, they think they get it, they only look at it as a negative. It's not. Okay.
I mean, it is if you're a short-term investor.
But that's not us.
Yeah.
So that's not what we're talking about. Okay. So If you can't sit through an average daily dip of -2, oh, that's another one up there too, which is on an average daily dip of 2% 5 times a year. Actually, that one's not up there. I should have put that up there. It's down here. A negative 15% temporary decline every year, an average 30% temporary decline every 5 years. You have no business being an equity investor. And then Nick Murray says it. This is like specifically from Nick Murray. So this is one quote I am going to read to you today. So here it is. If you can't ride out about a 15% decline virtually every year, and an average of twice that, perhaps 1 in 5 years, so negative 30, you simply can't be an equity investor. And we've agreed that without the historical return of equities, we know of no other way for you to achieve your financial goals. My greatest value to you will be coaching you through these episodes, but we must be fully aware that they're randomly coming like summer thunderstorms to be followed by bright new days. That's from around a year, October 3rd. Okay, so you may not memorize every little factoid, but you definitely want to do probably, well, you could maybe cut out number 2, but definitely you want to know that it's, and an easy way to kind of remember it is negative 15 every year, and then you double the negative, and it's every 5 years, right? So if you can't sit through a negative 15 once a year, a negative 30 every 5 years, then you probably shouldn't be an equity investor, but we've already agreed that you need to be. Okay, good. Julian, any response to that?
I definitely agree with that. And it's something that you want to keep reminding clients of, especially with times like this with COVID and whatnot. You want to let them know that you don't want to invest with emotion. It's going to go up, it's going to go down, but over the long term, it will increase and it will hit that 12%.
Yeah.
I like your dog analogy, the dog on the leash at the beach.
The volatility, yeah.
Yep.
Yeah. We have a whole training on volatility. We'll go through that one. That's a great, yeah.
And the yo-yo on the escalator.
Yep, all of them.
Yep.
Oh, I did want to mention, kind of along with this, more of as a concept, another great, the reason I ultimately I put together these 7 principles. Again, I didn't make any of these up. I just kind of collected them and then put them in a list. Was one, of course, for myself. I'm a little technical guy, and I want to have a checklist. I want to have like an instruction manual. But what I found was valuable. This is how you use it kind of in a little bit of a sales or persuasion situation. Is you like, look, Mr. Client, let's say, for example, because this goes to number 2. This is where I just thought of when I looked ahead at number 2. So number 2, stay diversified, right? So a client may say, well, I want to invest in individual stocks. So there's a lot of answers that we have a whole objection for. But one thing you can say is something like this. Mr. Client, let me tell you, there are 7 basic fundamental investment principles that any professional investment advisor understands and agrees and adheres to that's worth their salt. So let me tell you, number 2, and then we go, which we'll get into in just a second, like that. See, so it's like you
start with number 2?
No. you do not start with number 2 in this case. If the client says to me, hey, I want to invest in individual stocks, then my answer could be on any number of objections to actually specifically mention why you shouldn't. But what I would actually preface it by saying, Mr. Client, let me tell you, there are 7 basic investment principles that any professional investment advisor worth their salt adheres to and believes. Okay, I'm not going to go through all 7 to bore you, but let me jump to number 2. Okay, because I'm going to handle his question about stocks. But here's what's happening with the sales technique or persuasion technique. It's more persuasion than sales. I'm stating this idea that there exist these 7 principles, and I'm making the point that anyone worth their salt in our industry believes in them. I just made the damn things up, but I'm stating that these are like universally known. And now I'm creating credibility for this third-party thing called the 7 principles. And now I'm going to use them to make my point. Okay? That's what's same thing. It's a little bit like these facts, like these 7 investment facts. It's like, this is what it is. I'm not making this stuff up. This is the facts. The market went down by 15%. Dude, it's supposed to do that once a year. Like, why are we surprised? You don't talk to your client like that, but that's what you're saying to them. Okay? So let's say we'll stay diversified. So look, what you want to do is you want to invest in a broadly diversified, professionally managed collection of the world's great publicly traded companies. If you're not invested in at least like 100, 150, at least of the world's great companies, you're not diversified. And then you can go into all the other reasons why we have whole training on that. I'm just kind of giving you the list of the 7 principles.
And you just mentioned about that you made these. I don't think these are very sound things. I wouldn't say that that they should understand these principles, but they were just made up.
No, I'm not saying that to the client.
No, I know,
no.
But even to say that to advisors.
Okay. No, I'm explaining that as I said earlier, I've over the years and years and years, I've put these 7 together. These are not listed in a book. I put these together, right? I didn't make any of them up. They're all, probably every word on these is just taken from a lot of different places. What I'm trying to make the point is that to the client, I'm portraying it like these are universally known 7 principles. I'm also telling you guys behind the scenes that, you're not going to find these in some kind of like universal financial planning book listed in the nice 7 list. You're going to find every single principle in a good training. In fact, probably Nick Murray's probably said all of these in some way, but this is just a way that you can see. There's the old adage in sales is the credibility is the one thing it's the one ability you can't give yourself. Mm-hmm. Someone else has to give it to you, but it's also not just with you, it's also with facts that you state. If you state a fact and you just state it, it's coming from you. But if you take a fact or a factoid or a principle and you put it out in the ether, and then you talk about how great this thing is, now you get to use it with more credibility because it's coming from someone. That's all I'm trying to explain. Okay. So number 3 is take advantage of tax shelters, right? Variable annuities, 401ks, IRAs, 529 plans, et cetera, et cetera, et cetera. Right. Again, these are things that are very simple for you, but the client doesn't know these. Number 4 is invest a lot and do it systematically, which means because one thing you want to do is you want to get a lot of monthly drafts. I've been teaching this for gosh knows how many years, and some people do it and some people do it better than others, but it's one of the biggest single things missed in our industry as a whole, and that is because most advisors are trying to get the $1 million, $5 million, $10 million cases, and I hope all of you get tons of them. And a big part of our market, the middle American market, is underserved, where we are, especially our group, has a great opportunity. But you're not going to do the $2 million case in the middle American market very often. Sometimes you do. Someone has a large 401k or they sell a property to get inheritance, but usually it's not. Your bread and butter isn't that. But where you can do something where a lot of the higher end client advisors don't do is the monthly drafts.
And I think a good point with monthly drafts is that you get to take advantage of the volatility.
Of course.
So in that it's not just your existing money and rebalancing, taking advantage of it, but by putting more and more money and buying cheap when volatility is low,
Totally right. And there's huge benefits of it.
That's a good thing to say.
And everyone should. And some people do. I know, Julian, you've got, what was that client? You have a client has like a huge monthly draft, couple grand. No, more than that, I think, right?
So I have one of my clients is doing $4,000 a month.
$4,000 a month.
Wow.
Yes.
Automatic.
I wish I could do that.
Yeah, that's awesome.
All for shop.
That's awesome.
You'll have the time to really let it grow.
Yeah, it's fantastic. Yeah, so packs are great. And so for us, they're obviously great too because it stabilizes your income. And as Isla said, sometimes it keeps clients, even when the market's down, like, yeah, it looks like your account balance is down. But the other part of our investment strategy is we set up the monthly draft, and that means you're buying the stuff cheap. So you've got
more
both.
shares.
More shares.
And when it goes up, then you've got more money.
Absolutely. Right.
So I would just play with that volatility that, hey, you want bad month? Great. Great for us. We buy cheap.
We buy cheap. We buy inexpensively. Exactly right. If you notice, though, in the title, it also says invest a lot, right? So remember, these principles are really, I want to say it the right way, but they're almost like a sales technique, okay? It's like these are the 7 principles you tell the client. Say, look, you want to know the bottom line secret? It's all the stuff, some of the stuff where I told you, invest in mutual funds, whatever. But one of them is number 4 of the investment principle. You got to invest a lot of money, right? So, and you almost can't invest too much, right? Have you ever met a retired couple that said they're too financially independent? right? They have too much money. So
and you can enjoy it when, later in life.
Right.
You have so much more money to enjoy.
absolutely. So number 4, it's not just packs, it's invest a lot, right? Number 5, have an intelligent withdrawal strategy, which we just
Side
happen to
fund.
talk. We just happen to talk. Well, it's your pensions and Social Security level 1, level 2, which is your guaranteed income. Then you have your insured income, which is variable annuities, and those two together is your basic minimum. And then everything above that, which is really your lifestyle, what you really want is going to be your mutual funds, but as much tax sheltered as possible. And we just covered that last week. And then of course with the side fund. So the intelligent withdrawal strategy is all of those things together, and then how you withdraw it. We talked about that last Monday. Number 6 is investor behavior, and what that means, Mr. Klein, is you. Okay, because you can invest all you want, but if you get scared out of the market or you react inappropriately, meaning either you're moving money around or God forbid taking it out because you get emotionally caught up in the news, your neighbor, your coworker, or what you see online. That screws everything up. That goes back to number 1, right? Understanding how the market really works.
And I like your real estate analogy on that.
Yeah, absolutely right. So you might want to explain that. Look, if your house went down, if your house was worth 100,000, and then you look at the market just for kicks, you go online or whatever, Zillow or some website, or your buddy tells you who's an appraiser and says, "Hey, your house is worth 80,000. Would you sell it?" No, of course not. Then why would you do it with anything else? All right. But here's the thing: the antidote to that is me, which takes us to number 7. Right. So it sounds self-serving, and I get that, Mr. Client, but that's the reality. I understand that my number 1 job is not all the things I just told you about. Okay. My main job is to make sure about number 6 and to some degree number 4, but mostly number 6. Right. My primary job is it's one thing to help a client set up an investment strategy, IRAs, the kids' college funds, and then do the math and figure out how much you've got to save and pick the specific fund or funds. And that's important. And I think some people do it better than others. But at the end of the day, most halfway decent advisors can do a halfway decent job. The main thing I would do is 2 years later, when all the things that you were taught by your advisor or me kind of wears off, and then the market does something crazy. Or flip side, your nephew just bought Bitcoin, and on paper he just made 20 grand, and then now you want to get sucked into that. Well, that's where number 7, which is me, comes in, and that's helping you mostly avoid the big mistake, which what that means is taking the money out when the market's down, but also some of the more minor mistakes, which is getting greedy or what have you. So with those 7 investment principles, I think you can have a successful long-term investment strategy. Okay. So let me jump to Julian, since he's online. He's probably our most experienced advisor. Any comments or thoughts on all this?
No, this is really good information to know. And it's also really good information for the experienced people to just go back on. One thing is, we always love, and don't get me wrong, I'd love it too, is, hey, getting those big commissions up front if you're commission based. Not necessarily it's different on the fee-based side, but it's really nice to say, hey, I got like a $5,000 check. But what really is your bread and butter is going to be those monthly packs. Those are what's going to carry you through the slow months. But at the same time, that's also what's going to help increase your business over time. Just gathering all those packs, add it all up, does add up. Kind of like I believe it was your reference or Nick Murray's reference, just little kindlings all add up to a giant fire, and it really does.
Yep.
Yeah, shavings make a pile.
Yep.
Yeah, for sure. Yeah, packs are one of the biggest, most important things.
And if you lose a certain client, if you've got all these different clients adding, if you lose 1 or 2, kind of like the stocks, it won't break you.
Absolutely.
If you have one giant client and that one breaks or leaves you.
So true. Yeah, that's actually one of the big benefits of operating in the upper middle class market. And there's a number of benefits to that. Most people would look at like a disadvantage to a degree, because it's nice to get that $10 million client.
And a lot of prospecting to get all those clients. So.
Yeah, it is. But one of them is there's less competition. But the other one is that for whatever weird reason, most middle class families are more open to monthly drafts, or maybe, I mean, I don't know. It's not going to do a survey, but maybe it's just because the advisors operating in the middle class are trying to build a bigger, longer term income. So they're more apt to do that. Like I personally am at a point where I would rather have a client do their IRAs monthly than give me a lump sum check, even though there's more money up front. First of all, the problem with that is when January rolls around of the following year, I got to call them back up and have them add the money again. And I got to keep, and I have clients that do that. They insist on doing it every year manually. They want to do the whole thing.
Well, that's one of them is because he doesn't know Roth.
Yeah, but there's others too. There's others that just would rather do it. I don't want anyone touching my account. I'll tell you when we can do it. Or they're like, well, I want to get it all in as soon as I can to have it working for me right away, which I can't totally disagree with that. But I think dollar cost averaging is more valuable. But if you have a whole bunch of clients on dollar cost on monthly drafts, that saves a lot. That automates your business. That means next January you don't have to call them because they're automatically adding money to their as long as it's fully funded to their IRA. So it really does. And then also what happens with clients is sometimes they almost kind of it sounds weird, but they almost kind of forget they're doing monthly drafts, and they'll look at their account and be surprised how much it grew. And the reality is, well, it's because you're adding money. It's not just the market is that awesome, but they might just remember the $20,000 IRA rollover they did with you. Of course, you then set up a monthly draft, and they almost kind of forget that they're adding money. Now this 20,000 is worth 36 in a couple of years. Or like, how did that happen? Well, because you've been adding 5,000 a year for 2 years as well. And then so there's a lot of benefits to that. And so just kind of in summary here is the main point. The primary purpose, I think, of covering this today was more, and I've said it before, I just want to reiterate, it isn't just to teach you these principles. It's I keep saying it's like a sales technique, but it's a way to answer a lot of the questions, So I would recommend, encourage you to either memorize the 7, just at least the headings, right? Or print it out or have it on your phone or just make a note, 7 principles. Because you can answer a large majority of questions your clients have by referencing the set. That's the best way I can say is you have something to reference, right? And it's a great way to explain even you, right? It gives you an opportunity. So, investment principle number 7 is you want to have a coach. And primarily, not exclusively, primarily because investment principle number 6. You know what number 6 is? And they're like, no, I don't know what number 6 is, because maybe you haven't mentioned it. Well, number 6 is client behavior, right? Of all the principles, number 1 through 5 are mostly kind of mechanical things. Do this, don't do that, don't do this. I mean, number 1 is more about understanding the market, but number 6 and 7, 6 being is the client's behavior. It's like what you do, right? And then number 7 is something that helps you do the right thing, and that's the advisor. So that's really the purpose of these. I know that mechanically most of you probably know all what these things are. It's more about, this is what I've done a variation of this for many, many years, is having something to point to, having something to reference. That's the best word, having something to reference and then bring it to the client. Number 2 is number 3 is diversify your investments, right? You've got to diversify. That's just fundamental principle number 3. You must diversify your investments. It's crazy to put all your eggs in one basket, that type of thing. Okay. That was it. Anyone have any, anyone, I would be Julian, or you, I guess there's more than one person. Any thoughts, questions, reactions?
So if the client is willing and listening and interacting, would you go through 1 through 7, or because it sounds like from what you're saying, just go to any of the principles and use it as a credible kind of fact? But
the time I would go through all 7, if someone asks me a question like this has happened to me, is what's your overall investment philosophy? Okay. So, and most people are going to answer that by giving a full loan presentation, which is what I used to do as well. But that's not really what they're asking. They want more of an overview of kind of like, okay, tell me about, maybe it was a referral or someone's willing to meet with you and they're like, okay, just give me kind of a rough overview of kind of what you believe you should do with investing. And then that'd be the perfect time to do the 7. And you could do it verbally.
Yep.
And each one you can deep dive later. They may say, okay, tell me more about, how the market works.
And then I have a question for you, Julian. So when you're talking to clients, do you have like your script, or do you listen and then just answer according to just every question? Or do you try to direct it and have your script?
No, that's a really good question. I act like a doctor. You go into a doctor, you tell them everything that's wrong with you. That's exactly what I do. I sit down and I let them tell me everything that's wrong with them or their situation. From there, then I can adjust my, if you're using your script, or my conversation to pinpoint their needs. So now I'm prescribing them medication, unquote, to what they need. If they need to save for retirement, great. What do they have right now at this current time? If they have a savings, let's do a change of rep, take that over, and then we'll move it over to American. If they don't have one, hey, it's important. How much can they set off aside a month to get to their goals? And I say it a month because they're not going to have 10 grand up front, but I'm getting into a pack. So that way they're saving aside each and every month. And then, hey, guess what? Life happens. They may get a windfall. They may get a raise, and they can toss in an extra few bucks or a few $100 in a month.
Great way, because I know your style is also very friendly, guy next door, correct? You don't go in like this.
Oh no, no, you're exactly right. No, it's you don't want to do that, and everyone's different. Everyone has different approaches. Find your approach, find your niche, and grow in that, because everybody's different, and that will make you get successful.
Yep.
That's great. That's great advice, Julian.
Yep.
It's and this is what a professional does, and many of you, not just Julian, but Julian's obviously been doing this for a very long time and is a pro. And this is what I've talked about people before: is you want to get to the point eventually where you could do everything on the fly, because that's the way a professional and any service professional does. The doctor, the lawyer, the accountant, the CPA, whatever. You walk in a lawyer's office and they give you a flip chart presentation of how great they are, and the law firm. They say, okay, so just slow down. I know you're frustrated. You're obviously, because you're seeing a lawyer, but tell me a little bit about your situation. That's what probably something like that is what a lawyer would do. To be fair, I know when you're brand new, it's hard to do because you barely kind of even know all the intricacies. And that's why we have a presentation. It's kind of a paint by numbers and follow the bouncing ball and karaoke. And you should do that. But then over time, as you get better and better, and you've kind of heard almost every objection, and you've practiced and learned it, now you can do everything a little bit more free form. But you're not expected to do that in the very beginning. But Julian's exactly right, is ideally what you want to do is when you sit down, even if you prospected the appointment, because the dynamic can be different, right? Sometimes if people come to you, it's different than if you were trying to get the appointment and they grant you the appointment. I get that. But still, you want to do something like, okay, so why don't we just start? Why don't you, if you don't mind, tell me a little bit about your situation and, regarding your retirement and finances. And some people will just use that and unload, and some people are more guarded and they'll tell you a little bit. And they'll say, well, we're looking to make some changes, and maybe we should just start with, why don't you tell us about kind of your investment philosophy? So they'll turn it around on you, which, by the way, that's where these 7 could come in. But ideally, you want to be free form. And what I've always called it was called patchwork scripting, because my reps I would train would say something like, I don't want to learn scripts. I just want to, be natural. Okay. Well, you weren't born this way. Whatever words you're saying were learned too. They just might have been learned by osmosis. But where you do want to get to is where you've learned these individual scripts, these phraseologies, these little objections, and then you can use them. You can pull them out of your bag, your mind, whenever you need them. But ideally, you want to be able to freeform a little bit the way Julian was talking about. That's the ultimate long goal, and that's where the 77 can come in, because you can pull from it as you need it.
And it could be someone like me who butchers it. I know the knowledge, but I
Sure.
go like the total opposite direction of saying what I know.
Yeah, no, you're not that bad, and it's just a matter of practice, though.
Yeah.
I mean,
yeah, I haven't
right?
practiced the scripts.
Yeah.
But sometimes when you've asked me, so what is that script? And then I say it and I'm like, oh, I thought I knew it, but I
Sure.
don't really know it. I'm kind of searching for the right words to describe it.
I remember many years ago, in like 3 companies ago, there was a really big leader. Guy was making over $1 million a year, and he said, for you managers and trainers, whatever, he said, you want to really get a shock. He said, go grab some of your guys, your reps, and that's not gender specific. Grab some of your guys that are some of your top guys, been around for a few years, and go do a field training appointment with them where they do the appointment and you watch. You're going to be shocked how bad they are.
Yeah.
Okay. He said you will. They're getting through it. Because you're talking about some of your top guys, and there's two general parts. This gets to what you just said. There's 2 general, very general parts to being a good advisor, productive, successful advisor. One is knowing the knowledge. The second part, which I think is more difficult, is presenting, selling, persuading, that part. And I still screwed up to this day after an appointment on the recruiting side, usually, because it's the same idea. Everything I'm telling you works the same on the recruiting side. And I'm like, man, I did this, but I know it all up here, but how to present it the right way. So you want to work harder at presenting and scripts and overcoming objections and people skills and all that stuff. It's never ending learning than you do learning the data. The data really isn't that hard. Yes, you have to know what's a Roth versus traditional. Yes, how's the taxes different from a variable annuity than they are with a regular mutual fund, blah, blah, blah. Of course, you have to know that. But you can also very easily get that with a Google search. Especially you as an advisor, you know what to look for. A regular client will get just more confused, but you know what to look for. But the harder thing is that's why in our trainings, even like on Monday here, it's almost a little bit more generally on what to say, how to say it, and what we talked about today. Is like today wasn't so much about the specifics. Some of it was obviously, but it was more about the tool that you use. And that's kind of what Isla was alluding to. Is she knows a lot of stuff. You guys have probably seen it when we do the weekly quizzes. Most of them she gets it right, and this is the first time she sees it. But then being explaining it, well, the only way to get through that is practice your butt off, right? When you're in the shower or when you're in the car and you just go out loud, just start talking, or just practice with your spouse if or someone else. And then just when you go out in the real world and try it, and actually try it, and over again, pretend that you are an actor on stage. That's what I always had in mind. I said, if someone was paying me $100,000 to play the role of this salesperson in this situation, that was my little bit part in this movie, and this is what I had to say, how well would I learn it? Right. And even forget about the money, just about the embarrassment of screwing up on camera. Right. I would practice that's the way you want to think. Okay. All right. I think that's it for today. Julian, thanks again for being on. And one more time, happy birthday to you.
Yeah.
Thank you so much. Thank you.
All right. See you guys.